Uh, Good day, everyone. Today, I will be looking at inventory management process. We have a couple of requests, team of consultants and also students. I want to understand in details how inventory posting is being reported in the general journal under the chart of accounts. So, among the series of uh, tutorial will be releasing on inventory management process. This is one of them that will be demonstrating when item is being received and invoice at the same time. How does the inventory is being posted to the GL, and what are the number of general ledger entries that will be posted? What are the debits? What are the credits? These are significant, important for system accountants, for those that manage the operation of the business, irrespective of the business they are into, maybe a trading company, manufacturing company, etc. The most important thing is how when item is being captured, how system calculates the GL item that will be posted to the general ledger. And these are very important for every application and software. They have their way of setting up the structure of the account that will reflect under the various GL ledger entries, has been determined by their posting setup. Today we will be looking at how item purchase is being posted to the general ledger, and there are a number of factors that also influences how some of the transactions behave on the general ledger entries. Today we'll be looking at when an item is being received, an invoice at the same time. You receive the item, item purchase, you also invoices at the same time. And what are the way the item will be treated under the general ledger entries? Which account will be debited? Which account will be credited under the income statement and also under the statement of financial positions? So one of the things that we need to pay attention to is the inventory setup. The way we configured our inventory setup also determine how the postings will be done. This condition of some of the fields on inventory setups will determine the behaviors of the transaction posting. So at this stage, we'll be looking at the item, purchase, receive, and invoice at the same time. So item received, meaning that item ledger entries will be updated when you receive an item. But in this case, we are receiving the item, we are also invoicing. B, item invoice, the value entries will be updated. It is the value entries that will be committed to the general ledger. So, four accounts will be created when an item is being purchased. For this exercise, we are purchasing an item called winter bag, and unit cost is $10 per unit, and we are purchasing 100. So if you multiply 10 units, $10 multiplied by number of units, it will give us $1,000. So when these activities is being conducted and posted into the general ledger, these are the accounts that will be impacts. So number one, we are purchasing an inventory item. So the inventory accounts will be debited. So for every debit entry, there must be a corresponding credit entry. So the credit items will come, the credit value will come to direct cost applied. That is the account that is hosting the corresponding entry that goes to our inventory account. While the third one is we have the vendor account, the vendor that we are purchasing the item from. Is a liability that we need to pay when the invoice is being done. This account will be credited. While the corresponding account to the vendor credit account is the purchases. You can see for every credit entry here too, there must be a corresponding debit entry. So these are the four GL account that will be created as a result of the posting of the inventory. Meanwhile, before we go further into the system to show us how the process will work and how to see how these accounts will also be generated on chart of accounts. Number one, we have the debits for the inventory. Ordinarily, when an item is being purchased, what they want to see in their book is that the inventory is being updated. Then we have the inventory value and also the item ledger entry. When you go to the item card, the item card will be populated by the unit of the item being purchased. Why this direct cost apply, uh, we need to understand that it's more like offsetting account against the purchases. So you can see that the value that is being credited here will be the same value that will be debited. So meaning that both of these accounts are trade off. They are more like a trade off account because what is important in our book is our inventory is being debited and the vendor is being credited. These are what will eventually happen. You see the two accounts, the debit, direct cost applied account and the purchases are trade-off account, meaning that both of them will be zero. So in some set of some clients in conjunction with their consultant may agree that these two accounts will be represented by the same GL account. So in the background, it will be posted to the same GL account. So at the end of the day, it will be zero. Why some may leave it separately. And one of the reasons why we may also leave it separately is that there will be some instances where the direct cost applied account and the purchase account will not have the same value, meaning that there will be differences between how much the value that is being reported into direct cost applied account and the purchase account. And what are the reasons that we make this happen? I think we need to pay attention to this. One of the reasons is that it's possible when we receive an item and we have not fully invoiced the item. So we receive an item, 10 units of an item, which cost value of 1,000, but when we are invoicing it, we only invoice 5. So the remaining 5 that is left of the value will be reported into these two accounts. When we have the complete value of the item, total item received, while the purchases account will only have the value of the item invoice. So the difference that will be left on this account will represent the value of the item not yet invoiced. So let's go into the system and demonstrate some of these illustrations we have put up on the screen. Let's go into the system. So good. This is the Microsoft Dynamics 365 Business Central. This is the latest version of the application. It's 100% web-based. So we go into the item card to just confirm that the item we want to purchase is already been created. We call it a winter bag. So let's do search winter. It's already there, winter bag. Good. So we also have the vendor that will supply the goods. We have them already. So let's do purchase invoice. I'll create new. So pick the vendor we'll be purchasing the item from. Vendor, we call it winter bag vendor. So all the details will be populated. So we come into the line, we pick the item we want to purchase, winter bag. Winter bag. So location, you can have it in the respective place you want to bring the item into. Pick blue. The quantity that we are purchasing is 100 and the units per one is 10. So let's preview, just ensure that everything is intact. Post preview. Okay, document number. That is one of the reasons that the post preview is good. So it can tell you there's an error, then you can quickly fix that before the item will be posted. So I've inserted the vendor invoice number. Let me preview once again. I think it's cool. The process is being done and the working on it is showing. So let's wait for the pop-up. So though the item has been posted and we have before ledger entry, so let's post the invoice. The invoice is being posted. Um, do you want to open the posted invoice? Okay, yes, we can open it. From there to, so this is the posted invoice. Posted invoice. So from there, from the posted invoice, what I did, I want to look at the GL entries that the item, the postings we go to on our chart of account. I just, I'm here under find entries. I click on it, so you can see the GL entry. This is basically what we are trying to demonstrate to us. The GL entry is 4. So let me click on it to see the debit and credit. Very important. So this is the GL entry and this is the value. You can see I have, okay, I can also click filter to bring some of them up. So I try to just rearrange the numbers in a way that I want to be looking at it. So we have these two. One account is an account that is being debited. That is the inventory account, while the second account is being credited, which represents the customer's account, which is the vendor account. The vendor account is being debited. I mean the inventory account is debited with the value of the inventory, while the vendor needs to pay for the service that we have rendered from that we get from them, that is the purchase item we brought from them, is showing that we have a liability to settle. So we have the purchases account is being debited, as we said, while the direct cost applied account is being credited. As we said, these two accounts are offsetting accounts. They are not really part of the analysis that the system will accept from us. Yes, this is the item. This is the general ledger entries. So we can clearly see that the account 7191 is credited. That is direct cost applied, and I have another income statement account, which is the purchases. As I said, they are set of accounts. Both of them are not really important for uh, accounting for inventory purchase, but Microsoft Dynamics, in their own wisdom, uses as a basis to create an offset account and be able to uh, define the account that the item received go to. This is the inventory account, balance sheet account 2110, which is debit, and the vendor account 5410, which is credit. This is how the reporting will look like under our chart of accounts. So I will meet in the other series to explain further other aspects when we have